Three prices. One metal. Silver spot at $75.84. COMEX May 2026. Futures at $81.13. Shanghai SGE physical at an estimated $78 to $80. Those three numbers are not supposed to exist simultaneously. That gap is the signal. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver is pricing differently in three separate markets at the same time. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now back to the data. Lead story today: the COMEX silver futures market versus the Shanghai Gold Exchange physical contract. Silver spot XAG USD at $75.84 as of March 19th. COMEX May 2026 futures at $81.13. That is a $5.29 contango between spot and front-month futures. That spread is not normal carry cost. Normal carry on silver in a well-supplied market runs $1 to $2 maximum. $5.29 reflects something else entirely. It reflects delivery uncertainty. It reflects tightening registered stock availability. It reflects a market where paper silver and physical silver are no longer pricing the same reality. At the same time, the Shanghai Gold Exchange AG T+D physical delivery contract is trading at an estimated $78 to $80 per ounce. That puts Shanghai physical above COMEX spot by $3 to $5, but still below COMEX futures at $81.13. Think about what that sequence actually means. The physical market in Asia is already pricing above what Western spot says silver is worth. And yet Western futures are pricing above even that. Three markets, three prices, one metal. The divergence is what deserves scrutiny, not the price itself. The divergence. The ones paying attention already know what a three-way price split means in a physical commodity market. Before I show you the full data picture, consider this. The last time COMEX silver registered stocks were this thin relative to open interest, silver moved 47% in under 90 days. The data is already telling you something. Let's build it out. Now let's build the full picture because this three-price structure does not exist in a vacuum. CME Group publishes COMEX silver warehouse data daily. Total open interest across active silver contracts approaches 127 million ounces equivalent. Registered silver, the only metal legally available for immediate futures delivery, sits at approximately 33 to 38 million ounces, according to the latest CME Group warehouse report. That is a coverage ratio of roughly 1 registered ounce for every 3.5 ounces of open interest. April 2026 first notice day is approaching with 9.5 million ounces still open in contracts. If historical delivery rates hold, registered stocks absorb 1 to 2 million additional ounces within 2 weeks. If delivery demand spikes, as it has during prior squeeze episodes, the draw is significantly larger. The Shanghai Gold Exchange, China's primary regulated spot market for physical metals, requires physical delivery on every settled contract. That is the structural difference between SGE pricing and COMEX pricing. COMEX settles primarily in cash. SGE settles in metal. When SGE prices physical silver at $3 to $5 above COMEX spot, it is not an arbitrage glitch. It is a direct statement from the world's largest industrial silver consumer about what real metal is actually worth in that market right now. The rate of registered stock draw is not slowing. It is compressing into first notice day. The data is doing the talking. The ones who were called alarmist for pointing to COMEX warehouse ratios 2 years ago. They are not the ones who need to explain themselves right now. And here is what makes that picture even harder to ignore. The Shanghai premium over COMEX spot reflects three specific structural forces, not sentiment, not speculation. First, China applies a 13% value-added tax on silver imports. That alone mechanically elevates SGE pricing above international benchmarks. Second, the People's Bank of China controls silver import quotas, preventing efficient arbitrage from closing the gap. Third, Chinese industrial demand for silver from solar panel manufacturing, electric vehicle battery production, and consumer electronics has been running at historically elevated levels since 2024. At the same time, COMEX open interest at 127 million ounces equivalent sits against 33 to 38 million ounces of registered supply. That is not a contradiction. That is the setup. And before anyone takes that as a green light to act immediately, Setups can take a long time to resolve. Weeks, months. The structural picture is clear. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the DXY and macro environment, because this is no longer a backdrop. It is the primary variable. Here is the number most people are glossing over. 100.18. That is the US dollar index as of March 19th. Up from 96 in mid-February. A 5+% dollar move in under 30 days. Silver is a dual identity asset. It is a safe haven metal and an industrial commodity simultaneously. Dollar strength at 100.18 suppresses the safe haven bid. But it does not touch Chinese industrial demand, because China's silver buying is denominated in yuan and driven by manufacturing necessity, not dollar dynamics. Here is the unavoidable math. China installed 230 gigawatts of solar capacity in 2025, according to the National Energy Administration of China. Each gigawatt of solar requires approximately 15 to 20 metric tons of silver. That is 3.4 to 4.6 million additional ounces of silver demand per year for every 10 gigawatts of new installation. Markets are still pricing silver as if that industrial floor does not exist. Look at spot at 75.84 against SGE at 78 to 80, and tell me what probability you put on that gap staying closed. When markets start pricing the reality of what sustained Chinese solar installation means for physical silver supply, spot reprices toward futures, and futures reprice higher. That is the historical pattern. Every time physical industrial demand has outpaced paper market pricing in silver, it has not been different yet. Silver Western spot at $75.84. Shanghai Gold Exchange physical at an estimated $78 to $80. A $3 to $5 physical premium confirmed on the session. Short-term picture. The $75 level is the only number that matters right now on a closing basis. If silver holds $75 on a clean weekly close, the path toward 81 to 85 remains structurally open. If silver breaks and closes below $75, the next structural support sits at $68 to $72. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. Silver's daily range can move 3 to 4% in a single session. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, the tape will confirm or correct you quickly. The environment right now is binary weekend risk with oil above $97, a closed market Friday, and unresolved Iran conflict driving geopolitical uncertainty into the weekend open. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here's the honest truth. Both sides of this trade have a real case. And the one you ignore is the one that will cost you. So let's run both. The bear case is real. Silver breaking below $75 on a weekly close opens a retest of $68 to $72 as speculative COMEX longs liquidate into dollar strength. The DXY at 100.18 suppresses the safe haven bid, while stagflation risk reduces industrial demand forecasts simultaneously. If PBOC eases silver import quotas, SGE premium collapses, removing the single strongest structural bullish signal currently present. The bull case is equally real. COMEX registered stocks at 33 to 38 million ounces against 127 million ounces of open interest is the thinnest coverage ratio in years. That is a structural stress indicator on record from CME Group data. Shanghai Gold Exchange physical pricing silver at $3 to $5 above COMEX spot confirms the world's largest industrial silver consumer is paying above Western paper price for real metal. April 2026. First notice day approaching with 9.5 million ounces still open creates a near-term delivery demand event that registered stocks may not absorb without a price response. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. 3 markets are pricing silver 3 different ways simultaneously. That kind of structural divergence has never resolved by moving back toward the lower price. It resolves by the lower price moving up toward physical reality. The only question is when. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group at cmegroup.com for registered silver warehouse stocks and open interest. The Shanghai Gold Exchange at sge.com.cn for SGE. AGT plus D physical contract data. The National Energy Administration of China at neagov.cn for solar installation capacity figures. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.